For years, the world has watched Wall Street, expecting that if another financial crisis comes, it will begin here. After all, that's where the 2008 meltdown started. That's where the greed, the bubbles, and the panic first erupted. But what if this time we're looking in the wrong direction? Because the next global financial shock, the one that could shake markets from New York to London, might not begin in the United States at all. It could start quietly in Asia. And not because of one country or one bad decision, but because of how deeply connected the world's economies have become. Today, we'll uncover the warning signs most people are missing and why the center of the next financial storm could be far from Wall Street. A changing world order. The 2008 crisis was made in America. Banks in New York and London packaged toxic mortgages into securities, sold them worldwide, and brought the system to its knees. Since then, regulators have spent 15 years trying to bulletproof the Western financial system. Stronger capital requirements, tighter lending rules, stress tests, everything designed to make sure 2008 never happens again. But while the West was focused on fixing its past mistakes, Asia was building a new economic empire fueled by debt, speculation, and rapid growth. Now that empire is showing cracks. From China's $12 trillion local debt problem to Japan's unsustainable monetary policy to emerging markets drowning in dollar loans, Asia has become the world's financial pressure point. China, the giant with hidden wounds. It always begins with China. For decades, China was the unstoppable engine of global growth. But behind the skyscrapers and infrastructure projects lies one uncomfortable truth. China's economy runs on credit. After 2008, China injected a massive stimulus to keep growth alive. That money created what economists now call the biggest debt bubble in human history. Local governments borrowed to build cities, property developers borrowed to expand, and households borrowed to invest. Today, China's total debt exceeds 300% of GDP. Evergrande's collapse was just the beginning, a glimpse into a much larger structural problem. The difference between China and the US. America's debt is transparent and denominated in the world's reserve currency, the dollar. China's debt is internal, opaque, and politically untouchable. If confidence inside China breaks, if local governments or banks start failing, the shock won't stay in Beijing or Shanghai. It will ripple across every Asian market and then straight into the global system. Japan, the quiet risk no one talks about. While everyone's focused on China, Japan is sitting on its own time bomb. For decades, Japan has kept interest rates at or below zero, an experiment in monetary distortion unlike anything in history. The Bank of Japan now owns over 50% of its government bond market and a significant share of Japanese stocks. That means markets there aren't really free anymore. They're managed, artificial. And when the central bank finally decides it can't keep buying forever, prices will have to correct. A sudden rise in Japanese bond yields could trigger a massive sell-off, not only in Japan, but across global markets. Why? Because Japan is one of the largest foreign investors in the world. If it needs liquidity, it sells foreign assets, from US treasuries to European bonds. That would cause global interest rates to spike, and suddenly, what looked like a small policy move in Tokyo could become a global financial tremor. The forgotten players: South Korea, Taiwan, and Southeast Asia. Beyond the giants, there are the silent engines of Asia. Countries like South Korea, Taiwan, Malaysia, and Thailand. They are the backbone of global manufacturing and technology supply chains. But they're also deeply exposed to global credit markets. Many of their corporations borrow in US dollars but earn in local currency. That's fine when the dollar is weak, but deadly when it strengthens. Now, as US interest rates stay high and the dollar grows stronger, these economies are under pressure. Their currencies weaken, their debt servicing costs rise. Capital starts flowing out to safer assets in the US. It's a silent squeeze, one that could set off a chain reaction if global investors panic. Why Wall Street won't see it coming. Wall Street loves patterns. It believes the next crisis will always look like the last one. But this time, it won't. Because this time, the contagion will move through the veins of globalization, supply chains, currency swaps, sovereign funds, not just banks. Western regulators have fortified balance sheets, but they can't fortify confidence. And when confidence breaks, especially in markets as interconnected as Asia's, the speed of contagion will be faster than ever before. Remember, in 1997, the Asian financial crisis began in Thailand, and within months, it took down currencies and economies across the region. Back then, Asia was smaller, less connected. Today, it's the world's factory, investor and creditor combined. If it falls, the world follows. The irony, Asia's strength is its weakness. Asia's economic rise was built on globalization, exporting goods, importing capital, and maintaining stable currencies. But those same strengths now create its vulnerabilities. Because when global demand slows, or the dollar strengthens, Asia's export-driven model suffers immediately. And unlike in the West, Asian governments often control or guarantee much of their debt, meaning if corporations fail, governments absorb the loss. That turns private risk into public crisis. So, while Asia may appear financially resilient on paper, beneath the surface, it's a web of interlinked obligations, corporate, government, and household debts, all depending on the same fragile growth engine. The future, the crisis of connectivity. So what does all this mean? The next financial crisis won't start where we expect because the world isn't organized the way it used to be. In 2008, the danger was too much risk in one country. In 2025, the danger is too much connection between all countries. A debt shock in China, a yield spike in Japan, or a currency collapse in Southeast Asia. Any of these could set off a chain reaction. Globalization has made the world richer, but it's also made it more fragile. And the irony is clear. The very region that saved the world from the last recession might ignite the next one. We've just uncovered why the next global financial crisis might not start in Wall Street at all, but in the complex, interconnected economies of Asia. This isn't about fear, it's about understanding. Because when you see how global finance really works, you realize crises don't come from where we're watching, they come from where we're not. If this video helped you see the bigger picture, leave a like, subscribe, and turn on the notification bell so you don't just follow the headlines, you understand them. And let me know in the comments where you think the next crisis will begin. This is the economic mind, clarity over chaos.